We have a great panel today to cover trends in the provider services market from the corporate and real estate perspectives. Having both corporate finance and real estate service in-house, BGL has a very unique value proposition to entrepreneurial physicians, both with and without PE backing. After decades of time on task advising physician clients and practice sales, BGL brought real estate services in-house after seeing a real need to look at practice and real estate assets holistically to unlock more value for physicians. And that thesis has really proven out over the last 10 years. So similarly, our collaborative partners over at VMG have both corporate and real estate divisions, and their expertise and volume of work in the sector carries a lot of weight. So we're really looking forward to the discussion with them today.
Certainly very interesting times within the provider landscape in particular. One key theme that we track is seller valuation expectation lag. And you see starting in really Q3 of 2022, you saw some dislocation in the credit markets. That's certainly through the economy and healthcare, although more insulated from broader macro trends. It still is not completely insulated. So when we say that, we look at entrepreneurs and typically see a valuation expectation lag of almost 18 months. So M&A activity has been on the sideline by and large, just in terms of the volume. There are still definitely deals getting done. There are assets out there. There's a flight to quality. But from an entrepreneurial standpoint, we've seen almost an 18-month value expectation lag towards of what the perceived value dictated by a multiple of earnings or revenue. Private equity held assets seem to understand valuation trends or just expectations a little bit sooner. So that can be 6 to 9 months. But clearly, the markets have opened back up, but valuation in 2020 or valuation and subsequently deal activity in 2023 has been off a touch. We're tracking it. There's over 70 assets led by private equity backed assets in provider services that were due to come to market in 2023. So we see the back half and into the first half of 2024 to be big for provider services. This is across asset classes. And so there's a lot of core things that you will see, value drivers. Those hold true across sectors. We'll discuss a number of those today, but I would say those features are just exacerbated when you have debt financing, becoming less attractive.
But I think, as Kyle alluded to, there are a number of sort of macroeconomic drivers to what we're seeing as 1 to 2 turns down on overall valuations, roughly speaking, from where we were maybe a year or 18 months ago. Those, in large part are economic prospects, potential for recession, just general fear in the market, if you will, which has, certain investors wondering how aggressive they can be on valuations and not wanting to perhaps push the envelope too hard. The other being interest rates and debt, right? Money is more expensive than it was 18 months ago. And so, for you to run a model at, sort of up on your tippy toes gets a little bit harder when the leverage costs more. But I think beyond that, there are the same sort of inherent underlying risk factors apply as private equity and strategic buyers assess valuing a physician practice, whether it's sort of downside risk factors like concentration, that might be, concentration across physicians or providers, concentration across locations, concentration across service lines or payers, right? And so limiting that downside risk by spreading your revenue over a wider base in all respects. Other drivers of valuation include growth prospects, whether that be additional providers to produce more revenue, new service lines. We always say that new locations don't produce revenue, providers do. And so, how are you growing your practice? Are you organically hiring and building out de novo locations? Are you acquiring, and do you have a pipeline to drive growth, which will add, to your multiple? And then beyond that, I think it's strategic fit, right? Are you trying to be a platform, meaning are you looking to affiliate with a private equity firm, versus are you, in this market in particular, looking for maybe a strategic buyer who might have more of an appetite right now, or more of an ability, if they already have a DDTL or some credit facility to allow for acquisitions, they may be able to get more aggressive as they think about value. So there's a number of drivers. I think some of them are macroeconomic. Some of them are the traditional, are you growing? Are you diversified? Protecting the downside type factors.
I mean, I think, realistically, and Kyle touched on a little bit as well, that there's, I think from our standpoint, as we see it, very bullish on the amount of investment that we're going to see in transaction activity that we're going to see throughout the latter half of 2023. And a lot of that's going to be just driven by on the demand side. So, we started to see a slowdown in particularly the second half of 2022, as you started to have some of these, tightening of the credit markets, uncertainty regarding inflationary impact and ultimate recession, things like that. There was a bit of a more wait and see approach. And you all probably saw this as well, but just transaction activity slowed. The time that it took to consummate transactions slowed. You mentioned the disconnect between buyer and seller on kind of perception of value. Because of course, from a buyer's perspective, as interest rates increase, uncertainty on future growth potential, and then just the overall inability to put as much leverage on these deals as they had in the past. That all of that's going to ultimately impact the return on investment for a buyer, and so their perception is deal values calm down, but of course, seller's perception doesn't necessarily align with that, at least not at first. But no doubt, you're still going to continue to have very, very high levels of demand for healthcare, and specifically healthcare services assets. If we look overall, you've got somewhere, when you're looking at PE investment dollars, about 20% of that, at least from a historical standard perspective, is going to go generally towards healthcare. About half of that is then going to be focused in healthcare services, whereas the other half of that's going to be biotech, med device, pharma, healthcare IT, things like that. But and then, so if we look at kind of those parameters and sort of frame this market down, you've got upwards of $60 billion of kind of quote dry powder that's out there for private equity, private investment to invest in the healthcare asset space. And then once you multiply that through the use of leverage, you're talking maybe 3-4x that amount that's kind of waiting to invest within healthcare services, which I think again is going to drive a lot of activity. But yeah, John, I think everything that you mentioned there, as far as what's driving value, I mean, again, it's what is historical, stability of historical performance, as well as expectations of future performance. The relative, I think one thing that becomes acutely important in a lot of these transactions is kind of the implied level of profit that's being purchased. And a lot of that deals with post-transaction operating structure, post-transaction physician compensation structure. All those are very important, and you kind of balance, the ability to effectively scrape away some what would be formerly what would be formerly physician compensation that would then become profit for equity investment going forward. But then, kind of balancing that with ensuring that it's going to be a sustainable model going forward, where it allow the practice to continue to recruit in. So that's going to be a big piece of it. For your more capital intensive businesses, just the level of how the level of capital spend that would be required to continue to sustain growth going forward is going to be highly important. But a whole multitude of factors going into valuation and really kind of buyer perception of value overall.
Yeah, and Kevin, I'm glad you mentioned that because we've seen that get a lot more or come more into focus, the incentive alignment with respect to physicians and how they're compensated going forward and how much you're scraping, in particular in some of these higher dollar specialties like cardiology, which we'll get into later. Two other areas that I forgot to mention with respect to valuation, but perhaps go without saying, are reimbursement horizon and what may or may not happen. Another area is compliance, right? Some specialties are under more of a microscope than others, and that can impact how those specialties are valued from a private equity or strategic perspective.
Thanks for the commentary from the provider services side. Would like to turn it over to the real estate folks to give some complimentary commentary on the real estate market.
Thank you very much, Zach. So, when we look at the real estate market, very similar and comparable to the corporate market as well. So we've seen a 100 basis point increase in the 10-year Treasury, let's call it from this time last year to today. How that is played into the valuation of our similar real estate assets is really about a 50 basis point spread from where things were trading summer 2022 to summer 2023, which I think is very bullish and speaks to the strength and appetite for acquisition in the market. You've seen a number of groups really decrease their yield and spread expectations over the rate market in regards to just getting deals done. So we have a tremendous amount of velocity into the tail end of 2023, where first quarter and second quarter, really a dearth, a small amount of deals were consummated in those first two quarters. And because of that, acquisition candidates really are sharpening their pencils to go into third and fourth quarter of 2023. So we predict a very heavy pace of transactions to round out the year. Sean, what would you say to that?
Thanks, Clint. No, I agree with all those points, and I think perhaps just a few other things to note. Thinking about the real estate market more broadly, obviously there's been a pretty significant slowdown. You'll see a lot of doom and gloom in the news, right, as relates to kind of your more traditional office real estate as an asset class. But one unique feature with healthcare real estate, obviously with the underlying business, the provider service business being more, call it recession resistant than a lot of other businesses that you'll see. And obviously there's not really a work from home option quite as much in healthcare as you'll see in other businesses as well. I think what this provides is an asset class that has been pretty resistant from a pricing perspective as well as a demand perspective. Now, that said, there's still, I think, a gap in terms of valuation from kind of where buyer is right now to where seller is right now. But I think speaking to the strength of that asset class, you see that gap closing, despite the fact that the 10-year treasury rate, as Clint mentioned, is still up pretty considerably from last year. So I think that, as we look towards the end of this year, the investor community is very anxious to put money to work. And as cost of capital becomes more reasonable than what it has been, I think we'll see the pace of deals start to accelerate. Victor, and we'd be happy to get any commentary that you might have from a valuation perspective.
Absolutely. Thanks, Sean. Yeah, to kind of piggyback on that, a macro trend that is impacting all of our markets and our daily lives is inflation, right? Rising costs. So how does that affect healthcare real estate? How does it affect value? Well, you have a sector that remains heavily, provider and owner occupier driven. And they still need new space. They need to replace existing hospitals or existing portions of buildings. So when that cost to do so rises, it has, of course, an impact on existing real estate. And you see that if you look at rent rate growth trends. So on the one hand, you have sales volume is down nationally. Cap rates are slightly up, although there's certainly exceptions. But occupancy is up, and rent growth is strong in a lot of markets. And that kind of tells the story of the impact that rising costs are having on the industry. And correspondingly, that escalation in construction costs informs how we think about values with specialty facilities. There's an old adage that cost doesn't equal value. Well, except for when it does, right? If you need the space for your operations, if there's a strategic need for this piece of real estate, then sort of basic valuation theory is that it's worth at least what it costs, or it's worth cost plus, assuming the underlying business supports the tangible asset. And that's one of the unique aspects of healthcare real estate as a sector, whether you're an investor or a provider, is that interplay between real estate and operations.
Yeah, Victor, fantastically stated. Much appreciated.
So it would be great now to talk about some specific considerations for different specialties within provider services, which many have their own nuances. Both BGL and VMG have experience across a very wide array of specialties within provider services to speak to. So, I think from there, it'd be great to start with musculoskeletal, orthopedic, spine, pain, that continuum of care.
Yeah, I'm happy to lead off here, Zach. MSK is a behemoth in itself. You think about a lot of these subspecialties within in MSK come together to anchor physician-owned hospitals, where we have a lot of activity and transaction experience. But in terms of more the practice side, okay, this whole broad-based specialty is a beneficiary on a shifting site of service. So you've seen more things be allowed, more codes be released over the past 3-4 years from inpatient to outpatient. Orthopedics has been a benefactor of that in terms of total joints. In terms of interventional pain, there's always this back and forth, a bit of friction in terms of what is the preferred site of service. So I think when you're looking at those individual assets to say decidedly what is the model, ASC or in-office focused. But just starting, if you look at orthopedics, then say spine, then interventional pain, not a lot of activity in pure spine-based. A lot of them are tied with the hospital or part of other groups. You got orthopedics, volume has been down. That is a true case of quality over quantity. A lot of private equity investment starting probably pre-COVID came into orthopedics. It was a hot new specialty. It's just more nuanced than retail medicine. That's a fact. And we're seeing that with cardiology that Tideman will touch on later. But really, it's more of market development. There's an interplay with the health systems within orthopedics, and that is real. So I think it's not as easy to transact. These groups, they make a lot of money on their own. Most of them have captured a lot of ancillaries, which is important to value, and a lot of them are intertwined on their technical, on the surgery center side. So I think valuations in MSK kind of start at the top with orthopedics, but the key there is that it's definitely less voluminous than folks thought in terms of M&A activity in orthopedics. So perhaps pivoting over to the interventional pain, but one item that is, reigns supreme across MSK is you have a high yield per provider. And it's interesting to find this conflicting forces in terms of valuation, because less providers equals provider concentration, which would be thought of as a perceived risk. But the counter prevailing force there is ease to growth. If I need to recruit 5 providers versus 20 to yield the same earnings to the bottom line of business, it's perhaps easier to grow. You just have more yield per physician. So I think that's something we've seen in valuation, where it used to be more providers the better from a concentration standpoint. Now folks are thinking about my investment thesis. How quickly can I grow this? And in a human capital business, recruiting or acquiring less and getting more yield is now perceived as a faster pathway to growth. Where you've seen perhaps a slowdown in just the sheer volume of orthopedic transactions, interventional pain has been the most active. We've seen it since 2016, 2017. There were some reimbursement pressures, which are always looming in healthcare, provider services, reimbursed services. You always have to be on the lookout for reimbursement and compliance issues. Interventional pain had some issues in 2016 and 2018 with reimbursement. So there was a pent up supply of assets coming in 2019. You saw COVID. So we're seeing that continue to be unlocked in terms of pain management, broadly speaking. So 2021, 2022 is a big year, a lot of activity within pain. And I think valuations, there hasn't been a big dip in pain. Frankly, it trades on probably a tighter band than, say, retail medicine that can fluctuate, 3-4 terms or turns. So there's more, I guess, just in summary, more volume in pain than ortho. Ortho still trades at premium. A lot in this whole MSK, folks are kind of saying, look, easier said than done on volume of acquisitions. You got to think about a broader market development strategy. Squeezing ancillaries is still of paramount importance. And this yield per provider that once was perceived as a concern, folks are starting to see, well, perhaps there is that upside on the ease to growth.
Yeah, that's a fantastic overview, Kyle. I mean, just adding a little bit here, but I think you largely covered the specialty extraordinarily well. I mean, if we look at orthopedic, besides perhaps dental and ophthalmology, just from a pure volume perspective, you're probably talking about maybe third or fourth most active, just as far as total deal volume most recently. Orthopedic, I think it is. You mentioned it before too, but this is a really entrepreneurial base. So if you think about the physicians, the orthopods in particular, it over the past history here, they have investments in surgery centers. They've got DME within their practice. They may or may not have investments in diagnostic imaging and physical therapy. And so, they've explored a lot of those ancillaries already. And so, as far as unlocking, if we look at a kind of a traditional methodology for PE to unlock additional value, it would be introducing and really leveraging some of these additional ancillaries. And that can be challenging when you're dealing with a subspecialty that's really pursued that already and kind of has those subservice lines that are already in a bit of a mature base there. So I think, but clearly from a orthopedic perspective, because of the fact of kind of the inability to leverage some of those ancillaries, I think the big question that all the groups need to go to prospective buyers with is how do they achieve earnings repair on the back end? Are they going to have success potentially in commercial rate lift opportunities? Because we've seen some groups have success in that. We've also seen some groups not have success in the ability to really achieve those commercial rate lift opportunities on the back end. So I think that's something that you really want to understand if you're taking away what otherwise could be compensation. Well, where's the value on the back end there? And some of that will come through traditional earnings repair, and some of that will come through continue growth opportunities and expansion of the rollover equity on that side as well. Pain management, historically, I think we have seen it's a little bit more kind of retail focused than you see for orthopedics because you do have a direct marketing aspect of it. So the ability to kind of expand and really accelerate kind of the patient acquisition through direct marketing, through enhanced kind of branding and online branding. Your group's having a lot of success with that. So you do have kind of, a path, an immediate path forward of how do we amplify and accelerate this practice going into it. And then, the potential here too, because I know a lot of surgery centers are concerned about this, is the ability of pain to kind of move many of their procedures back in office. So if we think about the ability to capture ancillary services going forward, now you may have some challenges there just as it relates to non-competes to the extent that these pain management physicians are participating as equity owners in ASCs, but I know there is a concern amongst ASC operators that that pain can certainly move back in office, and from just a pure value-based play, that's looked at as attractive going forward.
Thanks, Kevin. To kind of go into ortho from a real estate angle, I think the question as a real estate analyst or investor or provider, or thinking about real estate value, is what are the real estate questions that are specific to this specialty? What are the build out requirements for a surgery center for ortho versus other specialties? We've talked about outpatient migration and procedures moving from a hospital setting to the outpatient setting. An example of that is in ASCs, you can do total joint procedures and spinal procedures that you couldn't do 20 years ago, but the operating rooms need to be larger to accommodate those. So some older ASCs may not be able to accommodate those procedures, and that affects their potential value from the real estate side. Similarly, I think about what are the barriers to entry as we think about value in a particular market. Is this a high cost market where it's difficult to build a new orthopedic facility? Are there limitations on available land? Is it a CON state? That theme of construction costs is very, very real when it comes to surgery centers, expensive to build. So if you're thinking about either investing in them, or if you're an owner operator and you're considering a sale leaseback, you're looking at what will investors look at my facility, or how will they look at it from a risk perspective? If there are those high barriers to entries, if it's a modern facility, and if your sort of capital strategy aligns with the sale of your real estate, it can make sense. But how does it fit in with physician succession, sustainability, long-term control? And I think that's probably actually a good segue, Clint, for you to maybe tackle some of those questions as you work with providers who are thinking through those things.
Certainly, Victoria. Thank you. When we look at the orthopedic, spine, and pain market from a real estate valuation perspective, really a number of things come to mind. First and foremost, we really saw the outpatient setting of care switch, a little over a decade ago. So this specialization in particular, you've seen really the fine tuning of outpatient procedural care. And then as we've gone into the 2020s, I really can't think of a specialization. Maybe secondly to cardiology would be just behind orthopedic care in regards for development. You've seen a large number of players who are established in the market looking to provide new operatory settings, as well as the path and growth of robotics in the field of orthopedic care. So you have, very high dollar builds, subsequently correlating to very high net operating incomes. As Kyle indicated, you have a very high EBITDA associated with provider base. So, all of these things have correlated to this being a very highly coveted subsector of the healthcare real estate market, in one in which we've seen really the most compressed capitalization rates attributed to acquiring these types of facilities, as just quite frankly, it's very difficult to put all of these kind of key pieces together. And once that is been assembled, there's a very high demand associated with those properties, and probably we would say the most compressed capitalization rates, highest valuations associated with the specialty type. Getting some of our acquisition candidates more acclimated to the space. Certainly when you have a condensed provider roster, in the past, 2-3 spine surgeons, maybe looked at in an unfavorable light. That now is really seen as understanding the market specialization and the market type. That 2-3 is fine at this point from a acquisition candidate standpoint on the institutional end. Just as Kyle has indicated, where you could quickly add 2-3 more and see drastic increase in EBITDA or EBITDAR there. So great horizon for the specialization, tremendous amount of development in the space, and one where we're very excited to advocate for our clients in this specialty type.
So the specialty that we've seen a lot of activity in is cardiology. So it would be great to get some commentary on that market from our provider services team and the business valuation team.
Yeah, great. Thanks, Zach. I can start off on this one, provide kind of an overview of what we're seeing, and then maybe the BGL team can get into a little bit more specifics on their dealings with their clients and that they've assisted from a transaction perspective. But cardiology market, that has certainly heated up here, in particular over the last, call it half a decade or so. If we think overall about sort of PE migration, and this is more broadly, not just cardiology focus, but the PE migration has sort of transitioned from low acuity up to high acuity, as groups have gotten more comfortable as within the healthcare provider space. And so, whereas you start off 10, 15 years ago, involvement was more on the dental, derm, some GI, things like that. Then you've moved into the complete other side of the spectrum, realistically, as you get into things like cardiology, like oncology, that are complex, that are more capital intensive. So the challenges as far as PE moving into that just has caused a little bit of a delay in the PE involvement in that space. And really what you've seen is the most recent increase in attractiveness of the sub-vertical here. Really, you've seen acceleration of that when some of these traditional hospital-based cath lab procedures and in-office cath lab procedures have moved into potential ASC settings. And so we talked about it some with MSK as well. But when you're talking about cardiology, you've seen a significant number of procedures that have moved from the inpatient only list, then been taken off the inpatient only list, and then being put on the ASC list as well. And so I think the interesting part about that, though, is you have perhaps a larger number of buyers when you're looking at cardiology practices. Not only do you have these platform entities that most of which are PE backed, but you also have what we've seen most recently is a lot of our health system and hospital clients are getting into the mix here too. They're concerned about, as these procedures have moved into the outpatient setting, that they're going to be kind of left holding the bag and not, have any involvement with what was previously groups that were very, very important and key to their surgical volume, their inpatient volume at their hospital, and ultimately their revenue generation and profitability. So cardiologists as a whole, they've got a long history of both hospital employment and being independent. We saw 10, 15 years ago, you had a huge wave of cardiologists being employed by hospitals. That, like a lot of subspecialties, hospitals would lose a fair amount of money with those large, on the professional side, with those large groups, those cardiology, those specialty groups. And so then many moved into their own groups and hung their own shingle there separately from the hospital. And now we're seeing a wave back, again, started with these PE-backed platforms, and now hospitals certainly coming into the mix as well, as trying to figure out how they can potentially align with these cardiologists as they're seeking potential affiliation, like a lot of groups are, as it becomes more challenging to operate independently going forward. So again, I think we're seeing within cardiology a lot of activity. I think we'll continue to see a lot of activity over the next couple of years, but certainly interested in the BGL team's thoughts specifically on their dealings with their clients.
Yeah, Kevin, thanks. I think, to echo a lot of what you were saying, we've seen cardiology really catch fire with respect to private equity, sponsor involvement and interest. Over the last 2 years or so, 10 platforms have formed up, and it's been really a land grab ever since to get as much scale and as many cardiologists up under these platforms as possible. And so the volume has been high. The constraint, to your point, is supply of available physician groups, right? 70 to 80% of cardiologists in this country are employed by health systems today. And so what's available to buy, if you're a private equity sort of roll-up strategy, really is the balance. And then I think, to your point, hospitals are getting quite concerned about the outmigration of volume, and how do they stop that, or how do they participate in that, right? And so you're seeing, at least in certain markets, health systems actually interacting and partnering with some of these private equity strategies to say, look, we understand that this volume is leaving the hospital. We understand that these doctors may even want to, reestablish private practice employment or come up under employment of one of these private equity strategies. And we could be okay with that, especially because as hospitals, we maybe weren't necessarily ever intending to be employers of doctors, but rather, a hosting facility for surgeries. And they're saying, okay, so how can we participate in this shift? And I think what you'll see is a lot of joint ventures on surgery centers, as well as other potentially creative partnerships with what will be the new professional group employers, the private equity roll-ups, versus, what has historically been a largely hospital employed specialty. I think it presents well for, the investor community, both on the real estate side as well as the corporate side, in that a lot of what's driving the shift and what drove the shift over the last 2 years and the big private equity push into cardiology is what you mentioned, procedures coming off the inpatient only list onto the ASC list. In particular, the big sort of turning point, as it's considered in the industry, was the allowance of PCI or stenting in the ASC. That was where everybody sort of tuned in and said, okay, this shift is real. We got some real procedure volume that's going to move into the ASC. You also think about the electrophysiologists who, if they don't have an ASC in their private practice today, they can't really do anything or participate in any sort of technical revenue streams. And then you mentioned, cath labs or OBLs. there's some things happening in the reimbursement environment there, which are making some of those procedures potentially make more sense in the ASC, which is a little bit of a more highly regulated setting with better quality outcomes. And then you think about, okay, how are we going to build that ASC, both from an operating standpoint as well as a real estate standpoint? There's investment that needs to go there. So Clint mentioned earlier in orthopedics that cardiology was a close second in terms of the need for dollars to invest in the right infrastructure to make cardiology make sense in the outpatient environment. Right. I think in GI, there's something like 1,000 GI specific ASCs in this country. In cardiology, I don't even believe we've hit 100 yet. And as you can imagine, cardiology doesn't make a ton of sense in like a multi-specialty ASC because you'll have, freeloader issues and things like that. Whereas, the trend towards single specialty ASCs is especially prevalent in cardiology. And so you'll need someone to invest in all of that infrastructure, which will have downstream benefits like, value-based care and things like that once we have all the right infrastructure in all the right markets. And then from an operating perspective, on top of things like working capital and getting these things set up and investing in, new physician guarantees and things like that, there's actual equipment and new technologies and these ancillary investments that physicians can make, but they're not cheap. Things like PET CT, things like, sleep medicine and sleep labs, even looking at, some of the preventive measures like RPM or CCM, right? There's any number of new ancillary opportunities within the specialty that all require investment and are becoming or driving the interest from the PE sponsored community. So I think all of these things are culminating in what has been a feeding frenzy for any and every available cardiology asset, coming and tucking up under what I believe is plus or minus 10 platforms today, with another, call it 10 to 20 private equity firms looking for a way to establish a platform. In fact, that we've seen that the appetite is so high for a starting point in cardiology, right? Because so many of these physicians went up under hospital employment that, there's just a lack of sizable, call it platform investments, right? So, traditionally a private equity firm might look for a starting point at plus or minus 10 million of EBITDA. That just doesn't exist in cardiology, across the country, and certainly not anymore, as a lot of these groups have been gobbled up. And so you're seeing these private equity firms really dip down low, and maybe they're starting with one or two or three sort of 2 to 3 doctor, what I'll call tiny groups, in a market where they might have a cluster or some scale, or they're friendly with one another, where they can say, okay, look, we can get a management team, we'll fund some working capital, we'll acquire, at a much smaller level than we otherwise would, just because we got to get a piece of this cardiology pie. So it's been an interesting market, at least from our perspective, in terms of activity and interest and valuation. Quite frankly, valuation in cardiology is one of those specialties that has been, bucking the trend, or frankly just disregarding what's going on in the broader market. So it's been active. I think I'd like to plug VMG. They helped us out on the QOV side, sell side QOV, for a big cardiology deal we did last year, and they did a great job. So I'll plug you guys there.
Yeah, thank you all, and I appreciate that commentary on the corporate side. As we think about the real estate aspect of independent cardiology practices or outpatient cardiology facilities, I think a lot of that is fairly a recent development, as John Tyman had alluded to. We've seen historically physicians, cardiologists, be largely tied to the hospital facility. Historically cath labs have been in the hospital, so doing a lot of the higher dollar procedures there. As we've seen, I think, coinciding with perhaps the expiration of some employment contracts for physicians with some of the larger systems or hospitals, and they think, okay, now perhaps we want to go back into private practice, form a group within their local market, and move some of these procedures out of the hospital as the inpatient only list has started to peel off and these procedures have been put onto the ASC approved list, now you're looking at having to invest real dollars into these outpatient facilities, be that an ASC or even in an office setting. But from an investor perspective, and on the real estate side, this is actually a fairly attractive proposition for a number of reasons. I mean, one, this drives a much more profitable underlying business, or the tenants within those properties is going to be a lot more profitable and have a lot higher debt coverage, so ability to pay their rent with a lower risk of default, which is obviously very important. But in addition, a lot of the specialization that's required for these facilities, right? So as Sean had alluded to, investing in a number of different new technologies, many of which are really kind of come part and parcel with the facility, so require some significant tenant improvements. That's going to drive some stickiness as well, right? So it's very unlikely that you see a cardiology practice or number of practices invest in an ASC and then go and start to drive procedures there for a couple years, and then perhaps now they look to move back and partner with the hospital system again. Unlikely that they're going to abandon that space in any way, and that space is going to be utilized for those procedures going forward. And so I think there's a stickiness there as well that is attractive to the investor community, because they know that's going to support a long-term stream of cash flows that they can rely on pretty consistently. Victor, happy to turn that over to you if you want to add any other perspective as relates to cardiology.
Yeah, on the cardiology front, to kind of piggyback on your comment, Sean, one of the things that I've seen is a repurposing of some other real estate space to cardiology use, and I'm thinking of a couple of examples of former big box retail stores projects that I've worked on, where a large cardiology group has turned those into space with cath labs and other kind of higher end build out. Which serves as an example of a couple of different macro trends intersecting, softness in the retail sector, availability of existing commercial space combined with demand more broadly in the medical space, this continuing to pound the drum of outpatient migration and these procedures being performed outside of the hospital setting. I think I remember a statistic of half of all cardiology procedures are projected to be performed outpatient by the end of this decade. So that's obviously driving demand to the real estate side. On the flip side, it is a space where you'll see some uneven distribution of coverage. Cardiology practices being acquired by a larger entity, and sometimes those acquisitions having overlapping and competing territory, and yet maybe having a white space or lack of coverage nearby. So when you're looking at a market and thinking about cardiology services, that's certainly a factor from a real estate perspective that informs risk of, to your point, Sean, of default or of honoring a lease liability. But otherwise, I think you all have covered it. A lot of analogs to the ortho space: high growth, high demand, high cost facilities. Certainly a strong subsector when it comes to the healthcare real estate markets.
Another specialty that's seen a lot of investment is urology. So from here, I'd like to turn it over to the corporate side to give some general market commentary.
Thanks, Zach. Urology is another specialty that is in high demand from the private equity community. Although, if you're sort of following closely, you might not see as much transaction activity as you would expect. Our feeling is that the reason for that is you saw 6 or 7 platforms get out in front of the wave of consolidation, and they were able to establish themselves as buyers in the market at premium valuations, frankly, right? Supply and demand was a large driver there. And you've seen those groups continue to be active from what I'll call an add-on standpoint. But what I think is interesting about urology is that we would have expected more platforms in the specialty, and we know that there are a number of sponsors looking to establish a platform in urology, right? It's a super ancillary rich specialty. Reimbursement has been very stable. The doctors make a lot of money, so the scrape can allow you to create significant EBITDA, right? We talked about yield per physician and other specialties earlier on. Urology is a specialty that is that way, right? In part because there are so many available ancillaries, as well as opportunities in surgery centers and radiation oncology and things of that nature. The reality is, I think this is a supply problem. It's a different supply problem than cardiology, which is more of there aren't that many independent cardiologists out there. In urology, those big sizable groups, I think, frankly, are just content. And they are, they're enjoying their lives. They're happy. They're doing what they want to be doing. They're running their practices. They are, savvy business folks, which has allowed them to invest in those ancillaries and grow their businesses and use that money to fund, physician guarantees and adding providers to their quote unquote platforms. And I think, as time goes on, it's really a matter of education, right? We'll see private equity continue to crack that nut slowly but surely. But it's proven to be slower on the come than perhaps we would have expected earlier on. I don't know, Kevin, is that sort of how consistent with what you're seeing in the urology market?
Yeah, John, I think you bring up an interesting point too, because clearly you saw kind of a big wave of some of these larger groups being formed, and a lot of that was starting in maybe 2019 into 2020 and 2021. And a lot of those were like the Solaris of the world, United Urology Group, U.S. Urology Partners. So a lot of your big name PE firms, started their platforms and have grown those platforms. But the number of platforms is really, is small. It's more kind of akin to your cardiology, despite the fact that, as you mentioned, you've got the number of available physicians out there is quite large. And you've got, generally what we've seen is urologists they tend to congregate in larger groups to begin with. And so you've got these large groups that presumably, if you're just thinking about it from a consolidation standpoint, the accessibility, availability of large physician groups make it kind of ripe, you'd think, for these roll-ups. There are, and it certainly is, very, very much ancillary rich, starting with like the labs and pathology, into lithotripsy, is a kind of a unique ancillary as well, that nearly all these groups have a significant stake in, and drive significant profit overall. That's the hard part. And one of the, that ambulatory surgery centers, radiation oncology, if we think about why hasn't there been as much activity, perhaps it lies in some of those ancillaries and some of those ancillaries potentially being tied up in non-competes. Clearly, they derive significant income from those ancillaries. The groups drive significant income from those ancillaries. However, don't have perfect visibility into some of those structures as far as non-competes and the ability of third-party buyers and investors to tap into those sources. Now, I would think something like, litho and maybe to a lesser extent radiation oncology and ambulatory surgery, but that income would come in through the practice base, which would allow potential monetization of that ancillary income stream in a platform transaction. But again, that I think maybe is just a little bit of the unique nature of urology specifically, and why we haven't seen as many deals as we have in certain other specialties for an industry that seems to be pretty ripe for it.
So chiming in on the real estate angle for the urology specialty, some of the same themes that we talked about previously with orthopedic and cardiology apply, although generally speaking, the building requirements are slightly less costly for urology clinics. That said, some of the full service clinics that may offer therapeutic radiation oncology, and they're going to have linear accelerators and vaults, are going to have very high building costs, and the same question of operational viability informing real estate risk and value is going to apply. There have been quite a few transactions that I'm sure Clint could provide examples of, sale leasebacks in the sector. And in my home state of Colorado, years back, the Urology Center of Colorado sold in a large, single site deal. They were a comprehensive single center that sold for I don't recall, 600 something a foot, and is an example of even 6 years ago the high cost and high value associated with one of these comprehensive urology centers that's offering a full array of services. With that, I'll turn it over to you, Clint.
Victor, thank you very much. And first off, at BGL, we've been very fortunate to be hired on the consultative side for monetizing a number of very large urology practices, real estate aspect of the practice. So that has been tremendous to work with those various practices. One of the key things, obviously, is the folks on the panel have alluded to previously, is the really congregation of urologists within a practice. You see, vast number of market share be associated with a dominant practice in a municipality. And additionally, when you look at urology residents, right, we've got 390 to 400 residents that are coming out per annum and are effectively the supply for the future of these urology practices. And it's a very competitive market to obtain these residents within the fold of the practice. Victor made an excellent point in the practices that are taking on these groups or these residents are those that have put in the work and the equity and developed cancer therapy centers, ambulatory surgical settings, very high level of clinical background in real estate. So, the rich have kind of become richer in the world of urology, and we would see that to be the bearing point on the horizon. But as a specialization and focus, very, very strong market indicators for the practice of urology.
Would also be great to get the team's perspective on ophthalmology. So if we could get some broader market commentary from the provider services teams, that'd be great.
So ophthalmology is interesting in that it's leading the charge when we speak about pent up supply. And that's led by private equity investment. So when you look at fund lives and investment horizons, there was a lot of activity in 16, 17, and 18 in assets that should have traded in 2023. So timing in terms of coming to market is going to be big for the next 9 months. But what that is culminating in is in a temporary depression of valuation in ophthalmology until some of these larger platforms reset. And by reset, it's trading from fund to fund at a higher valuation, just giving more room for the entire market to benefit from accretive valuation multiples. So if you look at other sectors where the roll-up strategies have been more mature in terms of just time on task. Ophthalmology has this unique paradigm where there are just not an abundance of larger players to do the larger deals. So you've seen somewhat of a donut hole in activity of, call it the 5 to 15 of EBITDA. There's not a lot of buyers not a lot of strategic buyers for the 15, 20, 30, $40 million EBITDA platforms. So those will have to come from trading sponsor to sponsor. So our view is that once those occur that are more dependent on the debt financing markets, so into 2024, that will trickle down back to historically, high valuations, which ophthalmology has enjoyed. The sector was on the verge of being just, in terms of volume and value, to be getting to the top end for retail medicine. And we've seen in the past year kind of a slowdown in both activity and valuation. But still, some of the core tenets of value that folks are looking for is an integrated model, ODMD, surgery center focused, single specialty surgical facilities. So there's a lot. Our team at BGL has done a lot on the real estate side as well, on within eye care, broadly speaking. And so it'll be interesting. Never a dull moment. But frankly, ophthalmology is a sector in retail medicine that we covered very closely, that we've seen a temporary downtick in valuation. Kevin will be interested to hear your thoughts from the VMG side.
Yeah, you bet. Yeah, we've been involved, with several of the prominent platforms out there making acquisitions and really assisting them. Some in two predominant areas, really, from both a quality of earnings perspective on the front end of deals, and then from a post-transaction perspective, doing valuation work for financial reporting purposes after the fact. We have started to get more involved too on personal goodwill. We have seen a number of some of these platforms, some of these targets, anyways, that are structured as C corps and are potentially subject to double taxation in the event of transactions. And from a more creative kind of deal structure of assigning greater value to personal goodwill, has an opportunity to make it a little bit more of a tax advantageous transaction. But I agree, the groups that we're dealing with are not behemoths. You've got almost a fragmentation of these platforms, in that you've got a lot of these platforms, and none of which have considerable dominant size. So as we look going forward, will we see consolidation that occurs amongst these platforms? I think you could. You also have had potential consolidation occurring as it relates to the more retail focus versus, i.e. there, like your OD components compared to maybe your more traditional ophthalmology based, or even what we've seen is more emerging here, and you really have one large provider being in the retina field, that with Retina Consultants of America. They have been highly acquisitive in large groups. When you're talking about retina groups that are largely kind of aggregated into fairly large, where you have many of which are 10 to 20 physicians plus. And so, could you see some kind of vertical integration there and consolidation within the ophthalmology field? I think you certainly could. And then again, lastly, on the ancillary front there too, most of these have their own single specialty ASCs, some of which are multi-specialty ASCs, but then you still have the same challenge of buyers out there of how do they unlock that potential value, because that's really the kind of the predominant value, especially for ophthalmology on the ancillary front, is in their surgical practices. So we'll see. I know, again, from an ASC front, there is concern as you start to see the potential to have cataracts move back in office. That certainly could kind of change the paradigm a little bit and potentially allow some of these groups to realize more value than they had in the past through capturing more of that ancillary income stream.
Well, appreciate that commentary as relates to ophthalmology. I think more in general on the corporate side. As we think about this from a real estate perspective, a lot of the fundamentals of that type of practice really drive through to valuation and activity within the real estate side as well. Having single specialty ASCs, oftentimes you'll see those single specialty ASCs kind of commingled with the clinic operations of an ophthalmology practice as well, and then the integration of the MDs and ODs kind of provides for a pretty unique profile, I think, from an investor perspective, namely because typically you'll get a lot more in terms of coverage, in terms of cash flow from the ASC, just given the technical fees that are driven from those operations. But then thinking over to the clinic operations of that, right? There are a lot of ancillaries that are involved there, particularly when you're talking about ODs, having optometrists in office who are largely driving higher volume of patient visits. And then separately, you have the retail component as well, which provides a bit of cushion. And so really in general, I think that when you're looking at assets like this, these are very attractive because you have complementary sides of the business, oftentimes within one facility, and then separately you just have multiple streams of cash flows that really reduce any risk of variability within kind of the profits of those specific practices. So which all of which make those very attractive for investors, and then obviously, it kind of goes to the specialization of the facilities as well. Any tenant improvements, any modifications required to the property, especially as you kind of work your way up the acuity chain within the outpatient setting, that just creates a certain stickiness, within the facilities, as pertains to, making sure that you're, keeping a practice within a facility, for the long term, right? It requires significant investment, and, having some skin in the game, from the tenant perspective is always going to be attractive to a real estate investor. Victor, it'd be, great to hear your comments on that as well.
Thanks, Sean. Yep, I'll touch on a specific issue that I see more frequently with ophthalmology deals than some of the other specialties we've talked about. With all the specialties we've talked about, there's a lot of times VMG's involvement on the real estate side will involve determining a fair market value lease rate for Stark law or any kickback compliance. And with ophthalmology, in a lot of cases, there will be a practice that will have satellite locations where they're going a day or a half day a week, what we'll call a timeshare or part-time occupancy arrangement. And I've seen particular deals where that was a major roadblock to be worked through because the practice had sometimes informal agreements with various physicians scattered around the state, other ophthalmologists. They come in and use the space because ophthalmologists use high dollar equipment. You might be coming in for a half day and using OCT systems or retinal cameras or fundus cameras or slit lamps or these things that are expensive. And so if you're paying for a half day block of use where you're paying for use of the space, use of the equipment, and a lot of times landlord provided staffing, a receptionist or perhaps a nurse, that all need to be accounted for in that block rate. In some of these physician to physician deals that have been maybe negotiated and structured more informally that are then being acquired by either a system or a PE platform that needs to ensure that those payments are at fair market value, you have to quickly determine whether they are in fair market value or determine or adjust them during the transaction. And those timeshare arrangements are quite common in ophthalmology and is a kind of a unique transaction issue to think about as someone proceeds through. Otherwise, I think a lot of the things you touched on, Sean, I would agree with. So I'll move on to the.
Would also be great to discuss dermatology today, an area where we have been very active. So we'll go ahead and turn that back over to the corporate side to get some broader market commentary.
Yeah, the beginning of investor activity in dermatology. It's more prudent to give an update. This is a sector in retail medicine that was at the forefront of consolidation, probably second to dental in terms of the most mature, in terms of number of participants. So an interesting dynamic that, at least leading from the private equity investment community, this is not a novel, or new, bright, shiny object. But it has been characterized in the past, couple years as one at which, we're probably on 3.0, the iteration of an investment cycle. So unlike perhaps ophthalmology, where there's a lack of strategic buyers, you have had 8 or 9 platforms reset, trade from fund to fund at high multiples. So as a subsector that whether you saw multiples waning, just given the maturity of it, the kind of parity of information, if you will, you just saw stuff cooling off, and then you had a bunch of the large players reset. So in terms of strategic exits propping up valuations, not all of these are not all of these are performing to perhaps where they would like to be. You've had some ups and downs, which is fine, and frankly is pretty normal in any given subsector. But now you've got a tale of musical chairs in terms of top buyers. So the fact that you have 8 to maybe even 10 buyers of $5 to $15 million assets helps keep valuations up, and then that trickles down to some of the smaller add-ons. I guess one interesting new concept is the higher acceptance of the pure cash pay cosmetic procedures folding into larger dermatology platforms. The sector was somewhat bifurcated for a while. There's a lot of buzz around med spa and plastic surgery, and dermatology players are buyers of those assets as well. So I think valuation, folks are looking at the full complement of services and some of the bread and butter stuff that we've spoke about. I mean, have you set up a business that has the infrastructure that's supporting both the providers and the patients, leading with quality care, retention, all those good things. So it's not new, but a newer feature is getting into the more cosmetic side, coming from the larger dermatology practices. Also, in largely a buy and build sector, there is a heightened emphasis that would lead to a higher relative valuations by demonstrating de novo growth. So it could be a land and expand, but that there is a premium currently in the market for those companies that can show a history of de novo versus M&A growth.
Yeah. Cal, maybe the only add-on I'd have there just would be what we've kind of noticed perhaps most recently is it's almost, and you mentioned it was early on in the adoption process as far as investment from platforms, outside investment into dermatology. And obviously there was significant income there generated by dermatologists that was available and allowed for some of this effectively monetization of what was formerly physician compensation. But those groups really early on, I think, showed the blueprint for independent groups of how to continue to expand, their income streams and get more into the retail function. So as they would introduce med spa, aesthetics, things like that into their practice, I think that kind of showed the blueprint for how existing dermatology practice and independent dermatology practices could certainly achieve some of that income expansion on their own without third-party investment. So, which may have caused a little bit of a slowdown of what we've seen more recently with dermatology. practices and investment by third-party private equity platforms.
Great. Very well stated on the corporate side. Thank you very much. From a real estate perspective, dermatology is another specialization which we've additionally have been fortunate to guide a number of practices through the monetization process of their bricks and mortar and their real estate. So a couple of the unique aspects of dermatology, right, is you have a very high level of clinical build in these types of assets. So you have a number of your Mohs as well as your image guided SRT procedural base, not quite a ASC setting in a lot of these scenarios, but really a very high acuity clinical setting. So with our unique knowledge and really lease rate that we've attributed to these practices monetization, we have a particular value add in the space where we can talk various acquisition candidates through what may be somewhat of an atypical type of a transaction where a lot of these acquisition candidates would think, well, clinical real estate setting is clinical real estate setting, but not all medical office settings are alike in that there is a drastic increase of acuity in the dermatological space that needs to be accounted for, quite frankly, in these monetization events. So it's not quite an ASC setting in a lot of these scenarios, but just under, and we're excited to give the thoughts in regards to those practices in monetizing the bricks and mortar for the firm.
Thanks, Clint. To kind of echo the commentary around distinction of different levels of clinical build out. You see the term surgery center thrown around a lot, and it's a through piece through a lot of these specialties that they have some form of surgical space or procedure rooms or operating rooms. And when you see an offering memorandum for a dermatology clinic, you may see a state-of-the-art surgery center. I think it is important to understand the distinction between building requirements for dermatological space versus urology, orthopedic, and so on and so forth. As a real estate analyst and someone who's called upon to provide third-party fair market value opinions, I see a lot of a muddling of those different asset types. Someone's arguing that their value or their lease rate should be X because, hey, here's a surgery center over here that sold or leased for this amount. Understanding what type of surgery center that was, what are the value drivers for the sticks and bricks, and then on the other side, not comparing a dermatology center to a standard medical office that's just basic exam room space. Yeah, I mean, I think that's kind of the main point that I would drive home is that dermatology kind of exists in this middle ground between the higher end ortho ASCs and more of a typical medical office space. And from a real estate perspective, just understanding where a particular property and building lies.
Outstanding. Thank you, Victor.
Finally, would be great to discuss gastroenterology. So I'll turn that back over to the team for some general market commentary.
Great. Thanks, Zach. Yeah, I think GI, if we look at the gastroenterology specialty as a whole, again, another one where you've had third-party investment, you had the formation of large platform groups for quite some time, not as early as perhaps your dental and derm, but We really started to see the first formation of these starting in kind of mid to late 2000. So you had 2016, you had Audax, which entered into and made an investment in GastroHealth out of the Florida market, which created a platform that then over the next 2 to 3 years expanded significantly beyond the Florida market. 2018, you had WAD and formerly what was Texas Digestive Disease Consultants that formed GI Alliance. Again, a group that's been highly acquisitive and significant growth story since their formation. Both of those large platforms there are kind of on their second roll at this point in time. You had Audax, who's now sold out to Omer's there with GastroHealth, and then there in most recently in 2021, late 2021, WAD exited their GI Alliance, which that one was a little bit interesting because it was more of a physician-led buyout, utilizing kind of hybrid debt capital from Apollo in funding that investment. But both of those at extraordinarily, what we thought at the time was kind of shockingly high multiples, up in the upper teens. And so, I think just as it relates to overall valuation for GI, again, I think these groups have seen, and their subsequent buyers have seen, that it is, it's highly fragmented, and these groups, there is a significant ability to advance scale there quite rapidly. And generally, what we've seen for GI, it's not as historically entrepreneurial as you've seen in perhaps some other specialties as well. So these groups coming in and offering their opportunity to expand ancillary, opportunity to be part of a significant growth strategy where they can show historically that they've unleashed significant equity value, rollover equity value to the groups that have participated with them historically, I think is highly attractive. GI as a whole, the specialty, it's again, this specialty, high number of ancillaries, some of which most groups have captured, some but not all. But you've got pathology, you've got infusion services. Certainly, quite a few of them will have anesthesia, led by typically CRNAs as part of their outpatient surgery centers. So they'll have employed CRNA groups that'll provide services and anesthesia services to their outpatient surgery centers. Some imaging, then you've got more of the retail, like nutrition and weight management that's incorporated as well. Again, another specialty where most of these groups have significant investments in typically single specialty ASCs, sometimes multi-specialty ASCs. So I think we have seen some groups come in, our dealings with them where perhaps they acquire a platform group, and the platform, the PE backers, thought that they would have an enhanced ability to capture more of the ancillary ambulatory surgery center income stream, and been faced with a little bit of challenges there just due to the non-compete issues and the fact that as opposed to owning unique aspect of ambulatory surgery, is most of the time you have the physicians who are owning directly independently, as opposed to through a group setting, and most of that historically for compliance purposes. But that inability to kind of unleash some of the ambulatory surgery center ancillary income, I think, has created some challenges. So a majority of the growth that we've seen is kind of through traditional buy and build. So just enhancing scale, leveraging multiple arbitrage of acquiring practices for lower multiples, and then experiencing very high multiples on the platform side. So again, a market that we've seen to continue to be very active, and we'd expect it to continue to be active moving forward.
Thanks, Kevin. From the real estate perspective, some of the PE activity that you mentioned, the platform roll up in the GI space, drives some real estate fair market value and compliance issues around lease rates. You see a lot of physician-owned GI centers, whether ownership is going to be maintained by the physicians or whether a third-party real estate investment entity separate from the OpCo PE platform is going to come into an ownership role in the real estate. And depending upon some of those structural considerations, you might need to vet whether the post-transaction lease rate is going to be adjusted. That, of course, can impact the operational cash flows and the price paid for the business entity. From a sticks and bricks perspective, gastro centers are, again, more valuable typically than normal medical office space. Build-out requirements not at the highest end of the ASC spectrum, but you do have surgical space, the need for anesthesia services, and high growth sector with a lot of smaller size transactions from a real estate perspective. So to kind of wrap up our specialties, gastro, is another one of these that's somewhere in this, from a real estate perspective, in this gray area between the highest end of ASC build out and high-end medical office typically from a value and lease rate perspective. Clint?
Fantastic. Thank you, Victor. Yeah, so we would echo the same sentiments that both Victor, Kevin, and John had. So, really in the gastroenterology space, somewhat akin to urology in a sense for the size and scale of practices in any one MSA. You have very much a aggregation of providers within the group, and typically a larger concentrated single tenant net lease scenario for the practice with a dual blend of clinic and ASC aspect to the practice. One that has been a space of focus for us, and quite frankly is going to be coveted for years to come in the institutional acquisition candidate world. Gastro GI is always a very good specialization, and one of which that has scale and will continue to scale. So any one dominant GI practice in an X municipality will typically be very highly sought after, and really from a secondary and tertiary market perspective as well. These are specializations that tend to draw from a very large catchment basin and very, very high level of care for their patients. And with that, that will conclude our specialization side of the conversation. One, would really like to thank Victor and Kevin with VMG. Really appreciate your time and expertise. We, again, as all of the members of our team have alluded to, have really enjoyed working with the VMG Health team in the past, current, and future opportunities, and really are appreciative of your insight and thoughtfulness in regards to the specializations as well as the market as a whole. Kevin, Victor, anything that you'd like to add there?
I'll go first here, Kevin. I just want to say thanks to the BGL team. Enjoyed the presentation and have enjoyed working with you all as well, and look forward to doing so more in the future. From the VMG real estate side, certainly happy to provide assistance to anyone listening who has fair market value needs on either a lease rate or value for any of the specialties discussed or other healthcare real estate assets. And Kevin, I'll let you kind of chime in on your end and maybe some of the other services that VMG can provide.
Yeah, you bet, Victor. Thanks. And again, really appreciate the BGL team hosting and our collaborative relationship with their team over the years. So, and I think as we've talked about during this roundtable, expectation is we'll continue to work together very closely, in high volume activity moving forward as well. So I think as it relates to VMG's kind of suite of services, we are certainly in position to provide target clients and really throughout the healthcare vertical. But specifically, I know we focused a lot on physician services here with compliance-driven business valuation work. Certainly, as a lot of these deals are set up, particularly in corporate practice of medicine states, there needs to be third-party opinions as it relates to friendly PC and overall MSA relationships. And our team's got a tremendous amount of experience in that, providing those type of opinions, doing quality of earnings analyses, which is part of most of these deals of any considerable size. And then on the post-transaction base, we do a lot of work with these platform companies as they make acquisitions, and we assist their treasury departments in providing valuations on a post-transaction basis. So happy to help however we can, and really appreciate the opportunity to participate in this.
Yeah, I mean, from a corporate standpoint, on the BGL side, just want to thank everybody for listening. Thank you to the VMG folks for joining us, and for Clint for putting this together. I think we're, available and interested in speaking with anyone who might want more insight in any of these specialties and what we're seeing in the market. And look forward to engaging further in the future.
I would just say, thank you to everybody for, participating today. Everybody who's listening as well. I think this was a very informed conversation, obviously, with our colleagues over at VMG. And otherwise, we're happy to help entertain any discussions and answer any questions anyone may have just regarding our perspective on what's going on in the real estate market. Obviously, these conversations can be fairly nuanced. Every practice is a little different. Every property is a bit different. And so, it definitely helps to, have an experienced advisor to help you talk through that. And we stand at the ready to help you with those discussions.